My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So this is the third episode of my Road to Financial Freedom series, and for those that aren't familiar, this is where I document the growth of a small portfolio that I started about 2 months ago, which I'm trying to grow as quickly as possible using the strategies that I talk about on this channel, like covered call writing and leaps option buying. So I started the account with a $5,000 deposit, and in addition to that, I'm also depositing $200 every single week. So the goal is to simulate the portfolio of someone working to achieve financial freedom starting from scratch, and to see how quickly it can actually be done. So with that said, let's open up Robinhood and see how the portfolio is doing so far. And by the way, given the recent events around GameStop and a few other stocks, which I'm sure you've heard about by now, I am considering switching away from Robinhood. So if any of you are using a different platform that you like, definitely let me know in the comments below. Really, for this challenge, my goal is just to use a platform that most viewers are familiar with. So if most people seem to be sticking with Robinhood, then I'm fine sticking with it too, but I just wanted to get some input before I make my decision. So anyways, looking at my account value, it's currently sitting at $7,794, and my total deposits are currently at about $6,600. So I'm up about $1,400, which is about a 21.4% money weighted return, so definitely very good for a 2-month period. And if I open up my spreadsheet, we can see a bit more detail. So we can see that 21.4% return equates to about 11.3% per month and 262% per year, which obviously isn't sustainable, but I do expect that I can maintain at least about a 5% or 6% return per month, which is what I've been maintaining with my main portfolio that I use for income, and that would equate to about a 100% gain per year. So you can quickly start to see that the strategy is very powerful if applied correctly. So let's take a look at where that gain came from, starting with my premiums from last month. So we can see that in January, I brought in a total of $551 worth of premiums, which is about an 8% return from premiums alone, assuming an average portfolio balance of about $7,000 for last month. And for the most part, I've been trading the same 3 stocks, Arcimoto, Virgin Galactic, and Zynga, but I did end up adding a 4th stock, which is Switchback Energy, which I'll get into in a minute here. So I do post weekly updates on my Instagram, which include the specific trades that I'm making each week and the calls that I'm selling each week. So be sure to follow me over there if you want more frequent updates on this portfolio. But essentially, I've just been continuing to sell weekly or bi-weekly calls on Zynga and then monthly calls on Arcimoto. And if I get called out on any of those calls, I'll just buy back into the stock and sell a new call against my shares. And if I don't get called out, I'll of course just hold on to the shares and sell a new call in that situation as well. And as far as Virgin Galactic, if you remember from last episode, I was just waiting for it to recover a bit. So sure enough, about a week after I made that video, the stock pretty much skyrocketed, reaching an all-time high of nearly $50 per share. And I had sold a 31 strike call, which wasn't set to expire until February 19th. So of course I wasn't able to take advantage of all of that upside. But for those of you that have watched my previous videos, you know that I'm perfectly okay with that. That just means that I made the maximum profit on that trade, and since I had an additional 30 shares on the side, I was able to take advantage of some of that rise and come out of the trade with a pretty hefty profit. So what I ended up doing is actually something that I don't do very often, but in this case I noticed that the delta of the call I had sold had increased to about 0.9, which essentially meant that I had captured 90% of my maximum profit on that trade. And you'll really only see this happen when your stock jumps far above your strike price, but when that does happen, you can buy back your call and right away sell your 100 shares as well, and come out of that trade having captured 90% of the maximum profit. So that's exactly what I did in this case, because I still had almost a month until expiration on that trade, so it really wasn't worth having all of that capital tied up for another month just to capture that last 10%. And I also sold my 30 shares that I had on the side, so overall I came away from that trade with a very nice profit. And at the value that Virgin Galactic is at right now, I really couldn't justify buying back into that stock, especially considering how uncertain and volatile that stock is. So I decided to walk away from it altogether and start trading Switchback Energy instead, which is ticker symbol SBE. And this is a company that I actually really like because they recently acquired the company ChargePoint, who's the largest installer of electric vehicle chargers worldwide. And as I've sort of alluded to in previous videos, I'm very bullish on the electric vehicle industry over the next few years, and I think aside from Tesla, this company is one of the most sure bets to be successful. They've already installed over 100,000 charging locations worldwide, and as electric vehicle adoption continues to rapidly accelerate, they'll be installing a lot more, so they definitely have massive growth potential. And just anecdotally, as someone who actually drives an electric vehicle, almost every time I stop to charge somewhere, it's a ChargePoint charger. so they're definitely pretty dominant in that field. So I ended up buying 120 shares of SBE at $40.72 per share. Then I sold a 43 strike call expiring February 5th for a premium of $195. And right now the stock is sitting at around $38 per share, but I'm not at all worried about that because this is another stock that is pretty volatile, so even if it drops a few dollars here and there, I'll still be able to bring in great premiums, selling calls at or above my cost basis. And again, it's a company that I really like for the long term, so I'm okay if I have to hold on to it for a little while. So now moving on to my long-term holds. Since the last episode, I've added 1 share of Square and everything else has just remained the same. So as of now, I'm up about $29 total on those long-term holds. Then in terms of Leaps options, I ended up selling my Microsoft Leaps for a profit of about $63, and I replaced it with an AMD Leaps after they released a very positive earnings report last week. They had by far their best quarter ever in terms of both top line revenue and profitability, and that made 2020 their best year ever in terms of both of those metrics as well, almost doubling their top line revenue from 2019. So this is a company that I'm very bullish on over the next year or two, and even though it did dip slightly after the earnings announcement, most likely just due to some profit taking and due to the overall market being down last week, I'd expect it to rise pretty significantly leading into the next earnings announcement. So I paid $825 for this Leaps option, which is a 165 strike call expiring on June 17th, 2022, and at the time I bought it, it had a delta of around 0.3. So I'm currently planning to sell it when it reaches a profit of about 10 or 15%. Now the last thing I want to talk about on this episode is my allocation, and essentially why I like to use margin and how I handle it. Because I know that some people are afraid of using margin, and it is true that it can be dangerous when used irresponsibly, but when used responsibly, it can be an incredible way to safely accelerate your returns without any extra effort. So I wouldn't use margin just to buy stocks that you plan to hold for the long term because there's no guarantee that your returns from those stocks will exceed the margin interest that you end up paying, which by the way generally ranges between about 2 and 8% depending on your brokerage. But if you're using margin to buy stocks for covered calls and you're using the strategy properly, it's a pretty safe bet that your gains will far outpace the margin interest. But even so, I never use more than 40% of my available margin because the last thing you want is to get a margin call when the market as a whole enters a downturn. And if you're not familiar with what a margin call is, that's basically just when you're borrowing more money on margin than your brokerage actually allows. So at that point, you'd either have to deposit more money into your account or sell stocks at a loss in order to pay your broker back. But if you're using less than 40% of your available margin at all times, the market would have to drop over 60% before you'd actually have to start selling stocks at a loss in order to pay your broker back. And that's of course very unlikely to happen. So after all, margin is basically just a form of leverage, and pretty much everyone who has ever become wealthy has learned how to safely and effectively use leverage to their advantage. And on that note, if you haven't seen my video where I talk about what I believe are the most important factors in becoming wealthy, be sure to click that video in the bottom right corner of the screen. Thanks for watching, and I'll talk to you all in that next video.